Hello, everybody. Welcome to StockMarketJobber.com. I am Mark. I will be your host for the day, or at least through this lesson. I have a pretty extensive background in trading. I know there's a lot of people out there that claim to be gurus and former hedge fund traders, but trust me, I actually was. All right. I was in business school. I got hired by Mario Gabelli and traded directly for him. He's one of the greatest value managers in history. Then I went over to trade directly for Steve Cohen, who is one of the greatest traders in history, or potentially is the greatest trader in history. I also spent some time at 3 different institutional money managers as the head of trading, so I oversaw pretty much every type of trading strategy you can think of. Yes, I did oversee hedge fund trading strategy, so I was a legitimate hedge fund trader. I also spent some time as a market maker. So what I want to do is just teach people that are new about how things on Wall Street and how trading really works. So here's a way to analyze SPY, or the S&P 500. All right, it's not the only way, but when you're in the institutional trading world and you're looking for trading ideas, you can kind of go through the market and let the market tell you what to do. You can't go in there with a preconceived notion. So we're just going to start off with the S&P 500, because this is what we call the mothership. The S&P 500 is the most important benchmark on Wall Street. So let's just talk about some market principles. Now, when it comes to analyzing the S&P 500, it's important to understand that different sectors drive the market at different times. In other words, different sectors are in the driver's seat. Maybe sometimes it's the financials that are driving the market. Maybe sometimes it's the technology sector. Maybe sometimes it's the healthcare sector. Things switch back and forth. It's not always the same. What's going on today might not be the same thing that's going to happen tomorrow or the same thing that happened yesterday. And within these sectors, there are different stocks that drive the sectors. So there are 11, the S&P 500 has 500 stocks, hence the name, and there's 11 sectors that make up the S&P 500, and the market, the S&P 500, is the sum of those parts. So we're just going to take a quick look through at the sectors, and I'm going to let you know what people in the institutional trading world look at. But let's just talk about some market principles. Well, first is that some price levels are more important than others, and you have to know where these price levels are if you want to be successful. Not knowing where the important price levels are is like being, at least to me, it's like a good analogy is that, like, you're in a town and you don't have GPS and you don't have a map and you're trying to drive around. Well, you're not going to be able to really know what's going on. So we need to know where these levels are. And this is important because money can be made when a market reaches these levels, because big moves tend to follow. An important price level is like a fork in the road. When a market or a stock or a crypto or an ETF or whatever it is you're looking at gets to one of these important levels, well, they generally don't hang out there too long. They tend to break one way or the other. So we need to let the market tell us what to do if we want to be successful. Well, how does the market talk? Well, it talks to us by how it acts when it gets to these certain levels. So these are called support and resistance levels. Now, when a market's going lower, it's because there's not enough demand or buy orders to absorb all of the supply or sell orders. So the sellers have to offer their shares out at a discount. When we get to a support level, the dynamic changes. All of a sudden, there is enough demand to absorb all of the supply, or there is enough buy orders to absorb all of the sellers. So a market sell-off will pause or stop and potentially reverse when it gets to a support level. When a market is going higher, it's because there's not enough supply to fulfill all of the demand. So the buyers need to be willing to pay a premium to get the sellers interested and get them off of the sidelines. When we get to a resistance level, well, the tide there turns. There's enough sellers or supply. I use the terms selling and supply and demand and buyers interchangeably, because when we look at charts, that's really what we're looking at. We're looking at a graphical illustration of supply and demand in a market. So we got to look for the support and resistance levels. Some of these levels can retain their importance for a long time, could be months, even years. This is called market memory. And believe it or not, and I'll explain why, levels that were resistance can convert into support, and levels that were support can become resistance. Now, speaking as someone who literally has traded directly with some of the greatest managers or hedge fund managers or traders in the world, I can tell you with 100% confidence that this is what they are looking at. They don't have these secret systems or these secret models that are infallible that a lot of people seem to think. All right, so let me go on here. So this is the S&P 500, and we can see right away that there are some price levels that are more important than others, right? If we keep moving ahead, we're at 405. There's a good chance there's going to be resistance at 410. Why? Well, it was resistance here, it was resistance here, and it was resistance here. This is an example of market memory. Down here at this important 390 level, and if the market does go lower, we're probably going to get a bounce off 390. This shows us how what was support can become resistance. This happens because of buyer's remorse. Buyer's remorse can turn support into resistance. People bought here, and assuming they still held their shares and the price went lower, a lot of the investors who bought regret doing so. So they tell themselves, you know what, I made a mistake. I want to get out, but I don't want to lose any money. So I'm going to sell it if it gets back up to my buy price so I can get out at break even. So you have remorseful buyers placing sell orders at the same level they bought at. This turns the level that was support into resistance. Now we have an opposite thing here. Resistance becomes support. This happens because of seller's remorse. Investors sold, the market went higher. A lot of the people who sold decide I made a mistake, and they tell themselves, I'm going to buy my shares back, but I'm only going to do so if I can get them for the same price I sold them at. So seller's remorse can turn a level that was resistance into support. And then we could see resistance become support. So it's all about understanding these levels. Now let's think about it. Like I mentioned, the S&P 500 consists of 11 different sectors. What are these sectors? Here we go. The biggest sector is technology. It's 26%. The smallest is real estate, 2.75%. So these guys down here, utilities, materials, real estate, they don't really have a big effect on the market. It's pretty rare that some of them are kind of in the driver's seat, but it's not uncommon for technology, healthcare, financials, consumer discretionary, industrials to be the important thing to watch. Let me just give you a basic, simple example, and it's never this easy, unfortunately, but let's pretend that the market has been going up. And let's pretend that every single sector in the market has been flat except for, hypothetically, industrials. Industrials is the reason why the broader market is going up or why the S&P 500 is going up. Well, let's just assume that the industrial sector gets really overbought and it gets close to resistance. Well, we can look at that and think, gee, there's a good chance that the market is going to go down because if the one sector that's been driving it higher reverses, well, that's going to reverse the market. All right. So it's important to look at all these sectors and see what they're doing, see where the support levels are, see where the resistance levels are. So we can see we got healthcare, financials, consumer discretionary. This is stuff, these are stocks that people, or I should say companies that are discretionary. Consumer staples is things that are considered necessary. Like a consumer discretionary stock might be a stock of say, a jewelry company. A consumer staple company is a company that makes food because you need food, but you don't need jewelry. A lot of times energy is in control because the higher the cost of energy, the higher the cost it is for companies to operate. All right, so let's go take a look at the biggest sector, and that's technology. Now we can see here, we have resistance becoming support, right? So for whatever reason, this 129.50 level is important. Remember, investors sold here when the price went higher. A lot of them regret doing so, so they try to buy their shares back. But they're only going to do so if they can get them at the same price they sold them at. So they place their buy orders at the same price they sold at. So remorseful sellers can convert what was resistance into support. Up here, we see that we have what we call market memory. Sometimes a level that was resistance can stay intact for a long time. So this level here first became resistance back in September, and this is around, I think it's about 139 resistance here. And if we move a little bit higher, we're going to get probably run into resistance and either stall out or reverse. Now, depending on how far down you want to take the analysis or how in depth you want to get, this is another thing to consider. Let's take a look at the breakdown of this sector. Just like the S&P 500 is 11 sectors, well, each sector consists of a different amount of stocks. Now, here's the important thing about technology. Notice how Apple and Microsoft together are about 43% of this index, or this sector, I should say. What we're doing here, I should elaborate a little bit. I'm sorry for not, but the S&P 500 is 500 stocks and it's 11 sectors. Fortunately for us, there are ETFs, exchange traded funds, that track these sectors. So what we're doing here is we're looking at it's called a SPDR because it's the S&P 500 depository receipt. It's not really important to remember, but this ETF, the symbol is XLK, tracks what's going on in the technology sector. Now, Apple, Microsoft together are 43%. So they dominate the sector in a big way. Well, what does this mean? Well, if you're trading technology, you got to keep an eye on these guys. Even if you're trading Adobe or Cisco, one of these smaller companies, in some way, shape, or form, Apple or Microsoft could influence what's going on with these guys, because if they're leading the sector higher or lower, a lot of times there's a lot of correlation with the stocks that are in the sector. They tend to move the same way. Now, that has to do with index arbitrage, and I don't want to get too into that now. Check out our site, stockmarketjobber.com, and you'll probably, well, not probably, but you'll be able to learn more about it. But my point is that there are two stocks that dominate this sector. These are based on market cap, how much the company is worth. And Microsoft has 5 times or 4 times the value as Nvidia does in terms of market cap. All right. I don't know why Visa is in here. To me, that would be a financial stock, but I don't make these decisions. So let's go to the first point. If you want to analyze the S&P 500, you need to know what's going on in the sectors. If you want to know what's going on in the sectors, you need to know what's going on in the stocks. And when you have these two stocks that dominate the sector, they're going to have an influence on pretty much every company within the sector. Now, we'll see some of these other sectors are not dominated as much as this is. All right, let's move right along here. Second biggest sector is healthcare, right? And we can see here a common phenomenon: resistance becomes support. Remember, remorseful sellers decide to buy their shares back after the price goes higher, and they place their buy orders at the same level that they sold at. And if there's enough of these remorseful sellers placing buy orders, the level that was resistance can turn into support. We can also see down here, support became support. Sometimes a support level can retain its importance for a while. Up here, this 134 level was important for a few months. Then we broke it, and now it's important support. Let's look at the breakdown of the healthcare sector. Now, as we can see here, this is different than the technology sector. There's a couple companies that are bigger than the rest, but they're not as big or as dominating as Apple and Microsoft are for the technology sector. But a good way to get trading ideas is if you look at something like this and you see, oh, gee, it looks like the XLV, the healthcare sector, is about to go higher or about to go lower. Well, the sector is really just the aggregate or the average of all the stocks that are within it. So if a sector looks like it's going to make a move higher or lower, well, there's going to be some stocks in the sector that look like they're going to make a move higher or lower, and they might move more than others, right? It's just, if you think about it, XLV is the average, it's the aggregate. So just by definition, if this thing moves up, there's going to be some stocks that move up more than it does, and some stocks that move up less than it does. So one of the things we do at stockmarketjobber.com to come up with trading ideas is analyze these sectors. And if we see a sector that looks like it's about to make an imminent move, we can delve into what stocks are in the sector to see if we can find something that looks particularly enticing. The financial sector is the next biggest sector. Notice how this resistance level here became resistance here. Right now, as I speak, it is, what day is today? I think it's January 29th of 2023. 3650 is resistance. It was resistance back here in early December, and it's resistance again. So this is market memory. Some levels are more important than others. Why is 3650 the level and not 3680 or 35, 95? I don't know, but we don't need to know. We just need to know where these levels are. This is your roadmap to success. Now let's take a look at what's going on in the financial sector, or what the components are, I should say. Berkshire Hathaway is 14%. So that's the biggest. JP Morgan is 10%. And again, these are based on the market capitalizations of the company, how much a company is valued at. But if you're trading Citigroup, you should watch Berkshire and you should watch JP Morgan, because they're going to influence the price of this probably. These ETFs are designed so they all kind of move in the same direction. And if an ETF gets ahead of itself and it gets to a value that's more than what we call our net asset value, well, let me explain that a little bit, right? We know where we can calculate exactly how much this XLF ETF should be, because we know how many shares of each stock are in it, and we know what the price is. So that's called the net asset value. If you take the value of all the companies and what their prices are and you add them together, that'll give you an exact value of what the ETF should be trading at. Now, think about this. If the ETF gets above its net asset value, the market makers, in this case are probably up at State Street in Boston, the market makers will sell short the ETF, and they will go out and start buying the rest of the stocks in the sector to cover their short. Now, as a retail investor, or even as a typical institutional investor, if you short something, you got to buy back the same stock to cover it. In the ETF world, the ETF market makers don't need to worry about that. They can use the stocks to cover their shorts, and they can use the ETF to cover if they go short the stocks. So if the ETF gets above its net asset value, the market maker will start shorting the ETF to who's ever buying it, and then they'll go out and start buying all the stocks to cover their short. So because of that, if XLF gets above its net asset value, well, the market makers are going to start buying all of these stocks. So that's why we have this correlation. When I started doing this, 30 some odd years ago, we didn't have ETFs. So you didn't have the correlations like you do now. So these ETFs makes our job as traders much easier. Our next sector here is consumer discretionary. Okay. This could be what we call a breakout. Resistance is a large group of sellers, right? As I stated before, at a particular level. A bunch of investors are, for some reason, trying to sell around 146.50. If we get above a level that was resistance, we call that a breakout. Now, this isn't just symbolic. This actually is an illustration of what's going on with supply and demand dynamics. If a market gets above a resistance level, it tells us that the investors who created the resistance with their sell orders are gone. They finish their orders, they cancel their orders, but regardless, they're out of the market. Anytime you take supply out of a market, the demand could force the price higher. It's basic economics 101. If you can understand that, you can understand how to be a good trader, right? It's not about having some magical system. It is overbought, though. Now, what does overbought mean? Well, the vast majority of the time, a market or a stock or a crypto, I typically just say stocks, but it's the same for any financial market. If it gets above its typical trading range, we call that overbought. And that's important because markets tend to reverse to their average. A lot of trading systems are built on the concept of reversion. So here's another thing. Markets that get to resistance while they're overbought tend to sell off. So there's a good chance that we see this sector go a little bit lower. Now, what's in this sector? This sector is dominated by Amazon. Amazon is a quarter of this sector. I mean, I don't know how many companies are in it. It could be 30, it could be 50, but this one particular stock is 25% of this sector. Tesla is 12%. So if you're trading Target, you should probably keep an eye on Amazon and Tesla because of the way the ETF arbitrage works, which I just mentioned. These stocks are all going to have some type of correlation. So regardless of what's going on in the market, in some way, shape, or form, let's just look at Starbucks. Starbucks will be influenced by the price of Amazon. All right. If the stocks get above the price of the ETF, right? If the ETF net asset value is below the price of all the stocks, the market makers will start shorting the stocks and buying the ETF. If they're buying the ETF, it's going to put some upside pressure on the rest of these stocks. All right. So sometimes sometimes sectors are dominated by one or two stocks. So if you're trading within that sector, it's important to keep an eye on the stocks that dominate it. Here's our industrial sector. You can see here this concept of market memory, clear support around the 97 level, clear resistance around the 102.50 level. So if we get up to 102.50 or back down to 97, look for support, look for resistance. And again, this is January 29th. I think it's I don't know if it's January 29th or January 30th. I'll have to check my calendar. Sorry, but ever since I work at home, I've kind of lost track of the calendar. Now let's see what's in this sector. As we can see here, this sector is pretty even, right? The biggest company is Raytheon, which is only about 5.2%. Honeywell is 5%. So these stocks are not going to influence the rest of the stocks as much as we saw with Amazon and with Microsoft and Apple. But it's just good to know within the sector. Like if we see that 102.50 level, that's resistance, starts to break and it looks like the sector is going to move higher, well, then we can go look at these stocks individually and see which one looks the most enticing, which one looks like it's going to break out and move up the most. And that's where we can allocate our capital to. I just can't emphasize enough how important it is to let the market tell you what to do. If you come in with a preconceived notion, it's going to be really tough. If you're agnostic and you come up and every day as a trader, you come in, it's like, all right, well, let me see what the market's telling me today. That's kind of the secret of success. If you come in with a preconceived notion of, oh, gee, today I'm going to go out and buy Union Pacific, but you don't have a logical reason for it, you're guessing. If you see, oh, gee, XLI is breaking out, it's breaking that 102.50 level, Union Pacific is really oversold and it's at support, so there's a good chance that this particular stock is going to move up more than other stocks in this industry, or I'm sorry, in this sector. Well, then this could be a good idea for a trading idea. All right. The best traders that I've ever worked with, and I've worked with some of literally the best in the world, they understand this. They understand that they can't guess. They have to let the market tell them what to do. Now, just for example here, our communication services sector, it's breaking out, but it's overbought. So there's a good chance that this is going to come back in a little bit. The market's going to consolidate. Things that are overbought, the overbought conditions drive sellers into the market because they're going to be expecting a reversion, and their selling could actually push the price down. So we could do a deep dive, and this is one of the things we do here at Stock Market Jobber, into these particular stocks that make up the sector and see which one looks the most overbought, which one is at resistance, and that's where we can develop a trading idea. So we got Alphabet, A and C. I don't know where this all comes from, but this is Google. So Google is 22% of this. Facebook is 16%. We go down to AT&T, it's only 4%. So if you're trading AT&T, you should keep an eye on Google and on Facebook because they're going to influence the price of the rest of these stocks. Trading doesn't need to be complicated. Wall Street tries to overcomplicate things so they can charge fees. A big problem is that 95% of the media or the commentators you see that talk about the market, they don't know what the heck they're talking about. These people are journalists, they're not former traders. So, I've been lucky enough to have been fairly successful. And now I don't want to use an overused term, but my passion is to teach people. And a lot of the people at Stock Market Jobber have really benefited from my experience. And that makes me happy. Now, let's look at this, right? We have this is consumer staples. Resistance becomes support. Seller's remorse can turn a level that was resistance into support. People sell, the price goes higher. A lot of them say, I made a mistake. I want to buy my shares back, but I don't want to pay more than I sold them for. So, what was resistance can become support because remorseful sellers are placing buy orders. Up here, we have what was support becomes resistance. Support can become resistance because of buyer's remorse. People bought, the market goes lower. They tell themselves they made a mistake. They want to get out, but they don't want to lose money. So they sell at the same price they bought at. So when we look at a chart, also you can see here the 77 level was resistance. When you look at a chart, it's not astrology, it's not reading tea leaves. If you view it correctly, what you're doing is looking at a graphical illustration of the supply and demand dynamics that are occurring within a market. Institutional traders don't look at things like Gabelli. They don't look at things like Elliott wave. They don't look at things like harmonic charts. That stuff is science fiction. Okay, if you want to, whatever. If you like it, good for you. But my recommendation is, if you want science fiction, Ray Bradbury, Isaac Asimov, real institutional traders who know what the hell they're doing are not looking at Gann theory. They're not looking at Elliott wave. At least in my 20 years in the institutional world, I never saw a competent trader ever once mention Gann theory. I mean, I would be willing to bet that if you went up to Steve Cohen or Mary Gabelli and said, hey, look at this Gann chart, they would probably fire you if they weren't too busy laughing. Anyway, let me keep moving on here. Here's our breakdown of the staple sector. We can see Procter & Gamble, the biggest company. Coca-Cola and Pepsi are in the sector, which I don't understand why, because staples are supposed to be stocks that you need or companies you need. It's like if an asteroid hits Washington, D.C., I don't know why you would need to stock up on Coke and Pepsi, but so be it. I don't make these decisions. Procter & Gamble makes healthcare products. All right, so that's that. Let me just keep moving along. This energy sector ETF is a perfect teacher, right? Look at this. Resistance became support. Support becomes resistance. Resistance becomes support. It's a good chance there's going to be resistance up here around 94. Why does the market like these levels? I don't know. The vast majority of the time when a market makes a big move, it's not because of what their media is telling you that's causing it. Like, oh, market's up on COVID, market's down on COVID, blah, blah, blah. It's because some sector somewhere broke an important level or a trend. Now, let's think about this logically, right? If every single little move of a particular sector or stock was based on some fundamental reason, other than investor perception and investment psychology, we wouldn't have resistance and support levels. Okay? When I was in business school 30 years ago, all we heard about was like random walk. Okay? The market does not follow a random walk. And it's also a myth that you can't time the market. If you know what to look at, you can time the market. I've known a lot of people that have gotten extremely wealthy by timing the market. So don't believe that. Just join stockmarketjobber.com, spend some time learning, and you'll learn what's important to look at. Like, why is it that this particular sector is the same valuation now that it was back here? Well, there's no valid fundamental reason. It's just investor perception. That's what moves stocks the most of the time. All right, let me keep going on here. But yeah, one of the things I like to tell my students is shut off CNBC, shut off the TV, don't listen to people in chat rooms. Listen to what the market tells you what to do. we can see here ExxonMobil and Chevron dominate this sector. Okay, together they're about 44% of the industry or of the sector. So if you're trading Phillips 66, you should pay attention to what's going on with Mobil and Chevron, because in some way or shape or form they're going to influence what goes on with these stocks. Here we have utilities. We can see support became resistance. Now it's support again. Pretty much any chart can show you these dynamics. Resistance became support. Resistance became support. See, people sold and price moves higher. They regret doing so. They want to buy it back. They place their buy orders at the same level they sold at. That's why what was resistance can become support. And we can see here NextEra and Duke. Well, really, NextEra is clearly the biggest company here, right? So if you're trading XL Energy, you should pay attention to what's going on here. As our materials sector, this really is a great illustration of how some levels are more important than others. Look at this 81 level. It was support, became resistance. If you asked a fundamental analyst, look at that resistance up there, or a professor, and you said, well, why is it that some price levels are more important than others? They wouldn't even be able to tell you. If you say, why was a level that was support miraculously converted into resistance and then turned back into support? They're not going to be able to tell you. Academics don't understand it. The people on TV don't understand it. But as traders, this is what we look at. Now we're testing this resistance around 84. Why is the resistance at 84 and not at 83 or 85? I don't know, but we don't need to know. We just need to know that it's there. Materials is dominated by Lind, 17% of the sector. So if you're trading DuPont, you should pay attention to what's going on in Lind, because Lind could influence what's going on at DuPont. All right, last but not least, here is our real estate sector. We can see, once again, there's a level that is important. We're testing this resistance around 39.75. And if we look at our real estate sector breakdown, we have two stocks that are about 23 or 24% of the sector. So these stocks, Prologis and American Tower, are going to have an influence on the rest of these stocks. All right, that's it, everybody. Thank you for hanging out with me. Hopefully you'll subscribe to our YouTube page and become a member of Stock Market Jobber. I know firsthand what successful institutional traders look at, because like I said before, I was in the world for a long time, and I'm confident that I can help you, and I look forward to talking to you again. Thanks, everybody. Have a good day.